Quick heads up before we start. This deep dive is brought to you by CertFuel. If you're studying for the SIE, they've got a full course with adaptive quizzes, smart flashcards, and unlimited practice exams weighted exactly like the real thing. Check it out at certfuel.com. Okay, let's get into it. Usually when we talk about a medical diagnosis, there's this expectation of pure precision.
Oh, yeah, absolutely. It feels very engineered.
Right. Like you break your arm, the x-ray shows that jagged white line, and the doctor just points at the illuminated screen and says, there it is. That's the fracture.
It's comforting, because it's tangible. You can see the literal physical mechanism of what went wrong, and the path to fixing it is standardized. A cast goes on, the bone knits, and you move forward.
Yeah, exactly. But then you step into the world of finance, specifically the regulatory landscape of customer accounts, and suddenly that x-ray machine is just completely busted.
It really is.
You are no longer looking at clean, binary mechanics. You are looking at a system built entirely around human behavior. We are looking at rules designed to prevent people from doing wild, impulsive, emotionally driven things with their life savings.
I mean, that's exactly what regulation is at its core.
Right. So if you are prepping for the Securities Industry Essentials exam, the SIE, you need to turn the volume all the way up right now. This material, trading, accounts, and prohibited activities makes up a massive 31% of your exam. It is the absolute core of the test.
Yeah, and the trap that catches almost everyone studying for the SIE is attempting to just rote memorize a dry list of regulations.
Yeah, the worst.
It really is. You sit there with flashcards trying to force Rule A applies to account B into your short-term memory, and that strategy just shatters under the pressure of the actual exam.
Completely falls apart.
Right. So our mission today is to completely rewire how your brain processes this regulatory framework. We are going to look exclusively at the why behind these rules.
Yes, because when you understand the systemic risk or the human flaw a rule was designed to prevent, you don't actually have to memorize the rule itself. It just becomes like the only logical conclusion.
Exactly.
We want you to deeply learn, retain, and, most importantly, apply this information when you are staring at a trick question on test day.
Yeah.
So to keep us anchored to reality, we are absolutely not going to talk about abstract concepts or generic like client A and client B.
No, that's too boring.
Way too boring.
Yeah.
We're going to use 3 recurring fictional characters today.
Huh.
And I want you listening right now to picture them in your head because they are going to act out every single scenario on this exam. First up, we have Reckless Ricky.
Oh, Ricky.
Yeah, Ricky is our impulsive, adrenaline junkie day trader. He loves breaking rules, taking wild leverage risks, and he genuinely believes he is the smartest guy in the room, despite the fact that his account balance is a smoking crater.
Basically, he is the reason regulators have nightmares. We see a terrifying number of reckless Rickies in the retail trading space. I mean, the industry literally builds firewalls to contain the damage they can do to themselves and to the brokerage firms that host them.
Right. So, next, to balance him out, we have Prudent Penny. Penny is cautious, methodical, and arguably a bit anxious.
Very anxious.
Yeah. She is a future planning rule follower who actually reads the terms and conditions on software updates. She just wants to protect her nest egg, avoid unnecessary taxes, and, set her kids up for long-term success.
And look, she represents the ideal retail client, but she comes with her own set of vulnerabilities. Brokers can take advantage of her passive nature, which is exactly why regulators have built an entirely different set of protections around her behavior.
Makes sense. And finally, we have founder Frank. Frank is a seasoned, slightly exhausted businessman. He owns multiple LLCs, he has payroll to meet, employees to manage, and he is trying to navigate institutional level money.
Right. He doesn't have time for Ricky's gambling, and he has way more capital than Penny.
Okay, so let's start right at the bedrock. Before we can even touch complex business trusts or retirement accounts, we have to understand the literal physical mechanics of buying a share of stock. How does the money actually move from a human to a market?
Yeah, the basic plumbing of the system.
Exactly. And that brings us to the simplest, most restrictive way Ricky can pay for his terrible ideas. Cash accounts.
So a cash account is the baseline. It is exactly what it sounds like. You purchase a security and you pay for it in full with your own settled cash by the required settlement date.
Right.
There is absolutely zero borrowing allowed from the broker-dealer. Anyone over the age of majority can open one. There are no special risk approvals needed because, honestly, the systemic risk to the brokerage firm is virtually non-existent. You're playing with your own money.
Let's use a visceral, real-world analogy to make the mechanics of a cash account stick. Think of reckless Ricky walking into a busy New York deli to buy a sandwich. He orders this massive pastrami on rye. The cash count rule means he cannot take a bite of that sandwich, and he absolutely cannot turn around and sell that sandwich at a markup to the hungry guy standing behind him in line before he actually hands his $20 bill over to the cashier.
That's a great way to look at it. And the timeline for handing over that $20 bill is strictly mandated by Regulation T, which is authored by the Federal Reserve Board.
Reg T, right.
Exactly. For most standard securities, like equities, settlement now happens on a T+1 basis. Trade date plus 1 business day.
Okay, so if Ricky buys stock on Monday morning.
The trade executes immediately, yeah. But he has until Tuesday to ensure the settled funds are in his account to actually pay for it.
But Ricky is Ricky. He is wildly impatient. He sees a stock tip on a Reddit board on Monday morning and hits buy for $10,000 worth of stock.
Yeah.
By Monday afternoon, the stock unexpectedly shoots up by 20%. I know. Lucky Ricky. Ricky looks at his screen and thinks, I'm a financial genius, and decides to hit sell right then and there to lock in his $2,000 profit. But he never actually deposited the initial $10,000 to pay for the Monday morning purchase. He just expects the broker to net out the difference and hand him the profit. What happens behind the scenes here?
Oh, behind the scenes, alarms are going off everywhere. He just committed a severe federal violation known as free riding.
Free riding?
Right. Free riding occurs when a customer buys a security and then sells it before paying for the original purchase. The Federal Reserve aggressively penalizes this because Ricky is essentially profiting off of phantom money.
Money he didn't actually have.
Exactly. He never put his own capital at risk. He took a free ride on the broker-dealer's capital during that T+1 window.
Okay, if you are listening to this on a walk or at the gym, listen closely. Stop what you're doing. This is an exam trap.
A huge one.
The test writers are going to try to confuse you by conflating free riding with day trading. They sound similar, but they are entirely different mechanical concepts.
Completely different.
Day trading is simply buying and selling the same security on the exact same day. That is perfectly legal, provided you have the actual cash in your account to cover the initial buy.
Right.
Free riding is specifically about the sequence of payment. It is about selling before paying. It actually has nothing to do with whether the transaction happens on the same day.
Yeah, Ricky could buy on Monday, wait until Wednesday, and sell the stock. If he still hasn't paid for the Monday purchase by Wednesday, he is still free riding.
And because he violated a Federal Reserve mandate Regulation T, the punishment is mandatory and severe. His broker-dealer is required to hit his account with a 90-day freeze.
Yep, 90 days.
Let me pause right here. I'm going to ask you, the listener, a direct question. Think about the answer before we reveal it. Ricky gets caught free riding. He gets slapped with this 90-day freeze. During these 90 days, can Ricky still buy stock in this account?
Take a bite.
Take a second. If you just said no, his account is frozen, he's locked out, the exam just stole a point from you. Yes, he absolutely can still trade.
The industry terminology here is intentionally confusing.
It really is.
The term freeze does not mean the account is locked down like a crime scene. What is frozen is his privilege of delayed payment. He loses the T+1 grace period.
Right.
For those 90 days, if Ricky wants to buy so much as a single share of a penny stock, he must have the fully settled cash sitting in his account up front before the broker system will even accept the buy order. He has been downgraded to a strict pay-before-you-play status.
So cash accounts are conceptually simple. You pay for what you buy with money you actually have. But reckless Ricky looks at his depleted checking account and realizes a painful truth. He can't make the massive market-moving bets he dreams of if he has to put up 100% of the cash every single time.
He wants more.
He needs more buying power. He discovers the intoxicating world of leverage. He discovers the margin account.
And this is the exact moment the regulatory walls get substantially higher. A margin account allows a customer to borrow money directly from the broker-dealer to purchase securities. The very securities that the customer is buying act as the collateral for that loan.
Wow.
Yeah, because the broker-dealer is now acting as a bank. I mean, they are literally lending Ricky cash out of their own reserves. They require Ricky to sign a comprehensive margin agreement to protect themselves.
And this agreement isn't just like one simple signature page. It is composed of 3 distinct structural parts. You have the credit agreement, the hypothecation agreement, and the loan consent form. I want to break these down meticulously because the exam loves testing your understanding of which document does what and which ones are mandatory.
Let's start with the credit agreement. This is the foundation of the loan. It outlines the mechanics of the borrowing, how the interest rates are calculated, how the debit balance is tracked, and the terms of repayment. You cannot borrow money from an institution without agreeing to the mathematical terms of the loan. Therefore, the credit agreement is absolutely mandatory.
Okay, that's one.
Second is the hypothecation agreement. Now, hypothecation is a dense legal term, but its translation is simple pledging assets as collateral.
Okay.
By signing this, Rickett is legally telling the broker, if I default on this loan or if my account goes negative, I grant you the unquestionable right to liquidate my stock without asking my permission to get your money back. Because the broker needs to secure their loan, this agreement is also strictly mandatory.
Got it. And then we arrive at the third document, the loan consent form. This document grants the broker-dealer permission to take the shares of stock that Ricky just bought and lend them out to other customers at the firm. Usually, these other customers are looking to short the stock. They need to borrow shares to sell them, hoping to buy them back cheaper later. Now, you listening, pay attention, because here is a massive exam trap. The exam will give you a multiple-choice question asking what is required to open a margin account, and it will list credit, hypothecation, and loan consent as an option. That is false. The loan consent form is completely 100% optional.
Yes. The logic here is really important. The broker-dealer does not need to lend out Ricky's shares to other people in order to secure his loan. Lending his shares is just a way for the broker to make extra revenue on the side.
Right.
Ricky has every right to say, you can hold my shares as collateral, but you cannot lend them out to someone else who wants to short the stock I just bought. So, credit and hypothecation are mandatory. Loan consent is optional.
All right, so Ricky signs the mandatory documents. He has his margin account open. Now we have to talk about who actually polices this borrowing, because there are two entirely different regulatory sheriffs in town, and they care about two very different things.
Okay, sheriff number one is the Federal Reserve Board, enforcing Regulation T. We mentioned Reg T earlier with cash accounts, but it plays a massive role in margin. Reg T dictates the initial margin requirement.
Why the Federal Reserve, though?
Well, because after the stock market crash of 1929, the government realized that unchecked borrowing to buy stocks could destroy the entire national banking system. The Fed steps in at the very moment of purchase to limit systemic leverage. Currently, Reg T says that when Ricky first buys the stock, he must put up at least 50% of the purchase price with his own cash. The broker-dealer is only allowed to lend him the remaining 50%.
Okay, so the Fed cares about the initial buy. But once Ricky owns the stock, its value is going to bounce around every single second the market is open. The Fed doesn't monitor the minute-by-minute fluctuations. That job belongs to Sheriff number 2.
FINRA.
FINRA dictates the maintenance margin requirement. FINRA's primary job here is to ensure that the individual broker-dealer doesn't go bankrupt because Ricky made a bad bet. They require a minimum buffer of equity in the account at all times.
A buffer, right? For long positions, meaning Ricky bought the stock hoping the price goes up. FINRA's absolute minimum maintenance requirement is 25% of the current market value. As the stock drops, Ricky's equity drops. FINRA draws a hard line in the sand at 25%.
And just to complicate things slightly, there is a third layer to this hierarchy, which we'll call the house rules. The broker-dealer itself can look at Ricky's trading history, realize he is a complete maniac, and say, look, FINRA requires 25% maintenance, but we don't trust you. Our internal house rule requires 30%.
They absolutely can do that.
Right. So the rule for the exam is this. Individual brokerage firms can always ask for more margin than the regulators require, but they can never, under any circumstances, ask for less.
Let's run a scenario drill to see how this math actually functions under pressure. Let's say Reckless Ricky finds a tech stock he loves. He decides to buy $20,000 worth of this stock on margin. Under the Federal Reserve's Reg T, what does he physically have to deposit to make this trade happen?
Well, Reg T is 50%, so Ricky has to wire $10,000 of his own cash into the account.
Correct. And the remaining $10,000 is what we call his debit balance. That is the cold, hard cash he borrowed from the broker. And here is the critical concept that trips people up. That debit balance does not shrink just because the stock price drops. He borrowed 10 grand. He owes 10 grand plus interest. Period.
Wait, slow down for a second, because this is where my brain always stalls out when I'm looking at a test question. If he bought 20 grand and put up 10, his loan is 10. What happens when the stock inevitably crashes? I mean, this is Ricky we're talking about. He buys at the absolute top. The stock immediately plummets.
Okay, let's walk through the mechanics of a market drop. The stock's market value drops from $20,000 down to $12,000.
Ouch.
Yeah, bad day for Ricky. So we need to calculate how much equity Ricky actually has left in the account. The formula for equity is incredibly straightforward. Current market value minus the debit balance. So the new market value is $12,000. We subtract the $10,000 he owes the broker. $12,000 minus $10,000 means Ricky's remaining equity is exactly $2,000.
Wow. He started with 10 grand of his own money, and now he's only got 2 grand to his name. He just incinerated $8,000.
But why does FINRA care? He still has some money left, right?
FINRA cares because that $2,000 buffer is getting dangerously thin. If the stock drops another $2,000, the broker's loan is suddenly at risk.
Ah, right.
So we have to test his current equity against FINRA's 25% maintenance rule. What is 25% of the new current market value? 25% of $12,000 is $3,000.
Okay.
That $3,000 is the minimum line in the sand. That is the maintenance requirement. But as we just calculated, Ricky only has $2,000 of equity left.
Oh, I see it now. The requirement is $3 grand, but he only has $2 grand. He is a full $1,000 short of the regulatory minimum. Precisely. $2,000 is only about 16.7% of the $12,000 market value. He has fallen completely through the 25% FINRA floor.
Which means?
This mathematical failure triggers the most dreaded event in trading, the margin call.
The dreaded margin call.
The broker-dealer will immediately contact Ricky, and they won't ask nicely. They will demand that he promptly deposit at least $1,000 in cash or fully paid securities to get his equity back up to that 25% minimum. And remember that hypothecation agreement he signed.
The one that lets them sell his stuff.
Exactly. If Ricky doesn't answer the phone or if he says he doesn't have the cash, the broker will simply start selling off his remaining shares of stock at a massive loss to generate the cash themselves. They will protect their loan at his expense.
Okay, stop right there. Time for a complete mental reset. Shake out your shoulders. If you are driving, tap the steering wheel. We are shifting gears entirely.
Let's do it.
Ricky is traumatized. He has been margin called 3 times this month.
Yeah.
His heart rate is permanently elevated. He finally realizes, you know what? I am my own worst enemy. I am terrible at picking stocks, and I panic when they drop. I shouldn't be making my own decisions.
A rare moment of clarity for Ricky.
Right. He decides he wants to hand the wheel over to someone else. He wants his broker to do the driving. And this brings us to a concept where test takers hemorrhage easy points because they overthink the definitions. Listen to the 3 A's.
We are entering the realm of discretionary versus non-discretionary accounts. A trade is only legally classified as discretionary if the registered representative, the broker, makes the decision on any of the 3 A's without getting the customer's explicit prior approval for that specific trade.
The 3 A's: asset, action, and amount. Let's define them so clearly you can't forget them. Asset, ACANEC. What specific security to buy or sell? Are we buying Tesla or Ford? Whether we are buying or selling, are we going long or getting out? Amount, how many shares are we transacting?
Right. And if the broker chooses even one of those 3 variables on their own, the trade is discretionary.
Just one is enough.
Just one. And regulators do not take discretion lightly. To legally execute a discretionary trade, 2 massive compliance hurdles must be cleared. First, the broker must have written power of attorney, or POA, signed by the client, securely on file. A verbal, yeah, sure, buy whatever, over the phone means absolutely nothing.
Good to know.
Second, because the broker is now acting as both the advisor and the executor, the firm requires oversight. Every single discretionary trade must be reviewed and approved by a principal, a licensed supervisor at the brokerage firm, promptly after the trade occurs.
Let's test this with an interactive scenario for the listener. Listen to the exact phrasing here. Prudent Penny calls her broker on a Tuesday morning. She says, I've been reading a lot about Apple's new product line. I want you to buy 200 shares of Apple stock for me today, but I know the market opens volatile, so use your expertise. Wait and get me the absolute best price you can find before the market closes at 4 p.m.
A very Penny move.
Very. Does the broker need written power of attorney to execute this trade for Penny? Take a beat. No. The answer is no. This is not a discretionary trade.
Let's break down why. Did the broker choose the asset? No. Penny chose Apple. Did the broker choose the action? No. Penny said buy. Did the broker choose the amount? No. Penny explicitly ordered 200 shares. Penny nailed all 3 A's. What she delegated to the broker was simply the time and the price of execution.
Time and price.
Right. Choosing the time or the price is the great regulatory exception. It is not considered discretion. It is considered standard broker service. The exam will absolutely try to trick you with a time or price scenario, trying to make you think it requires a POA. It does not. Time and price exceptions are valid for that business day only, but they do not make the account discretionary.
So if the rules around the 3As are so clean, why do regulators care so intensely if a broker has discretion? Why is this one of the most heavily scrutinized areas on the SIE?
Well, it comes down to human nature and how brokers get paid. Whenever you hand over the power to make trades to the person who profits from making trades, you create a massive inherent conflict of interest.
The fox guarding the henhouse.
Exactly. This entire dynamic is governed by the SEC's regulation best interest, commonly known as Reg BI. Reg BI legally mandates that broker-dealers and their representatives must act in the best interest of the retail customer at the time the recommendation is made, without placing their own financial interests ahead of the customer's.
So to understand the traps here, we have to do a direct side-by-side comparison of the two main compensation models in the industry: commission-based and fee-based accounts. Let's look at a commission-based account first.
Sure.
In this model, the broker acts like a toll booth. They get paid a discrete fee, a commission for every single transaction. You buy 100 shares, they get a cut. You sell those shares next week, they get another cut.
Which is mathematically best for someone like Prudent Penny. Penny is a classic buy and hold investor. She does her research, buys her 200 shares of Apple, pays the broker their commission one time, and then sits on that stock for 10 years. She isn't bleeding fees every month.
But now, imagine if Reckless Ricky gave his broker full discretionary authority, power of attorney, inside a commission-based account. The broker now has the legal power to decide what to buy and sell, and the broker gets paid every single time they pull the trigger.
Right, and this creates the environment for a severe violation called churning. Churning is defined as excessive trading in a customer's account that is specifically designed to generate commission fees for the broker without providing any actual investment benefit to the customer.
It looks exactly like this. The broker calls Ricky and says, "Hey man, I bought you IBM on Monday, but the charts look weird today. I went ahead and sold it and bought you Microsoft. But honestly, tomorrow I might flip that into Tesla." The portfolio value isn't growing. The broker is just running Ricky's money back and forth through the toll booth, farming commissions. That is churning, and it will end a broker's career.
It absolutely will. Now, flip the script. The industry saw the problems with churning and pushed toward the other model, the fee-based account.
Okay, what's that look like?
In a fee-based account, the toll booth is removed. Instead, the customer pays a flat, ongoing percentage of their total assets under management, let's say 1% annually, regardless of how many trades are executed. If you trade once, you pay 1%. If you trade 500 times, you pay 1%.
This model is actually perfect for someone like Reckless Ricky, right? An active, high-volume day trader. He can execute hundreds of trades a year, and his administrative costs are capped at that flat fee. It aligns his costs with his behavior.
Yes, perfect for Ricky. But the regulators noticed a new problem. What if an unscrupulous broker takes our buy and hold investor, Prudent Penny, and convinces her to open a fee-based account?
Oh no.
Yeah. Penny deposits $1 million of her retirement savings. The broker charges her that 1% fee, which is $10,000 a year, every single year. But Penny never trades. She just holds her mutual funds.
So she's paying for nothing.
Exactly. This trap is called reverse churning. The customer is paying an ongoing, hefty, parasitic fee for absolutely zero active management or trading service. The broker is getting paid 10 grand a year to literally do nothing.
The exam requires you to view this from both angles. You must match the compensation model to the client's actual trading frequency. Active traders belong in fee-based models. Buy and hold, passive investors belong in commission-based models. If a broker mismatches them to generate higher revenue for the firm, it is a blatant suitability violation under Reg BI. Okay, let's track back to Ricky. Ricky tries the fee-based discretionary account, but honestly, he gets bored.
Yeah.
He misses the dopamine hit of pushing the buttons himself. And trading standard stocks on margin just isn't giving him the wild leverage he craves. He wants to unlock the casino. He wants to trade options.
Oh boy.
But when he logs into his brokerage portal and tries to click Open Options Account, the system throws up a massive red stop sign. The broker-dealer makes him jump through a series of intense hoops. Why the sudden friction?
Because the nature of the risk fundamentally changes with options. Options are derivative contracts. They are incredibly complex, highly leveraged, and inherently dangerous for retail investors who don't understand the math.
Way more dangerous than regular stocks.
Way more. With standard stocks, the worst case scenario is the company goes bankrupt and the stock goes to zero. You lose what you invested. But with certain option strategies, your potential losses can be theoretically infinite. Because of this catastrophic risk profile, the approval process for an options account is built like a fortress.
So who holds the keys to this fortress?
First of all, a standard branch manager, the person who approves a cash account, is not qualified to approve an options account. It requires review and sign-off by a specialized supervisor known as a registered options principal, or ROP.
ROP. And the paperwork timing surrounding this approval is one of the most frequently tested concepts on the SIE. This is an exam trap. Listen carefully to the sequence of events.
Very carefully.
Before the ROP can even legally review Ricky's application, the firm must deliver a very specific government-mandated booklet called the Options Disclosure Document, the ODD. It is basically a terrifying manual of all the ways you can ruin your life trading derivatives. The exam trap is the timing. A question will ask, when must the customer receive the Options Disclosure Document? It will offer answers like, at the time of the first trade execution, within 15 days after the account is approved, when the first monthly statement is generated?
No, none of those.
The rule is absolute. The ODD must be delivered at or before the time the account is approved. The ROP cannot legally sign the approval paperwork until they have confirmation that Ricky has that risk disclosure document in his possession.
And even with the document delivered, the ROP isn't just going to rubber stamp Ricky's application. They are required to conduct a rigorous suitability assessment. They have to evaluate 4 specific factors: the customer's stated investment objectives, their current financial situation, their historical trading experience, and their actual comprehension of options risks.
Imagine Ricky's application. He fills it out and says, my objective is to turn 10 grand into $1 million by next Friday. My financial situation is that I have $14 in a checking account and a leased Honda. My trading experience consists of watching 3 TikTok videos on a bus. And my understanding of risk is that risk is just a construct for cowards.
I am going to guess the registered options principal does not approve Ricky for level 4 naked call writing.
The ROP probably frames that application and puts it on their wall as a joke. But no, Ricky gets entirely rejected. And that brings up the concept of cumulative options levels.
Brokerages do not just grant a binary yes or no to options trading. They don't hand you the keys to the entire casino. They use a strict, tiered system, typically ranging from level 1 to level 4.
Let's explore why these tiers exist. Level 1 is the safest tier. This allows strategies like covered calls and protective puts. Why is it safe? Because in a covered call, you already own the underlying stock. If you sell a call option and the buyer exercises it, you just hand over the stock you already have in your account. The risk is completely capped and covered.
Right. But level 4 is where fortunes go to die. Level 4 allows naked or uncovered call writing. Let's explain why the risk is infinite. In a naked call, Ricky sells someone the right to buy 100 shares of a stock from him at, say, $50 a share. He collects a small premium for selling that right, but Ricky doesn't actually own the stock.
So what happens if that stock gets caught in a massive short squeeze and rockets to $1,000 a share?
Well, the buyer exercises their right to buy it at $50. Ricky is legally obligated to deliver those 100 shares. Because he doesn't own them, he has to go out into the open market and buy 100 shares at the current price of $1,000, spending 100 grand just to turn around and sell them to the guy for 5 grand.
Wow.
Yeah, there is no mathematical limit to how high a stock price can go. Therefore, Ricky's potential loss in a naked call is literally infinite. That is why level 4 requires massive net worth and decades of experience.
The key takeaway for the SIE exam regarding these tiers is that the levels are cumulative. If a highly experienced customer is evaluated and approved for level 3, which introduces complex spreads requiring margin, they do not need to submit separate paperwork to get approved for the lower tiers. They are automatically granted permission for level 2, which is buying calls and puts, and level 1, which is covered calls. The higher clearance implicitly includes all the lower clearances beneath it.
Exactly. It cascades down.
All right, let's transition our narrative. Ricky somehow lied his way into a level 2 options account. And predictably, he blew it up. He bought a bunch of out-of-the-money put options, the market rallied, and his options expired utterly worthless. He has lost all his money.
Big ol' Ricky.
He is desperate to keep trading, but he needs fresh capital. So he hatches a plan. He decides he needs to pool his money with other people. He approaches founder Frank and Prudent Penny to team up.
Oh, this should be good.
This forces us to look at how the regulators handle multiple human beings owning a single account. We need to cover joint accounts, corporate accounts, and partnerships.
Let's start with the mechanics of joint accounts. These are brokerage accounts owned by 2 or more individuals. There is a foundational, non-negotiable rule that governs all joint accounts, regardless of the specific type. On the trading side, any one owner has the full authority to act.
Any one owner.
Right. Ricky can call the broker on a Tuesday, completely ignore his co-owners, and execute a trade to buy 500 shares of stock. He doesn't need to gather signatures to make a trade.
That sounds dangerous for the others.
It is, but however, when it comes to the flow of funds out of the account, the doors lock. If Ricky requests a check or a wire transfer, the distribution must be made payable to all named owners on the account collectively. Ricky cannot quietly liquidate the portfolio and wire the funds into his own secret personal bank account in the Bahamas.
Okay, that protects the group from outright theft.
Yeah.
Now, within the umbrella of joint accounts, there are 2 main legal structures you need to compare side by side for the exam. The exam loves making you choose between JTWROS and TICIC. Let's look at JTWROS first. Joint tenants with rights of survivorship.
Okay.
Let's imagine Ricky actually opens this type of account with his very patient wife. In a JTWROS, all owners have an equal, undivided interest in the assets. You don't own specific shares, you own the whole thing together. But the crucial mechanism is right there in the name, survivorship.
Exactly. When you see survivorship on the exam, you need to instantly think bypasses probate. Probate is the slow, public, often expensive legal process of validating a will and distributing assets after someone dies. In a JTWROS account, if Ricky passes away, his share of the account does not go into his will. It does not go to probate court.
Where does it go?
By operation of law, his ownership stake immediately and automatically transfers to the surviving owner, his wife. She simply presents a certified death certificate to the broker-dealer, and the entire account becomes hers seamlessly.
Now contrast that seamless transfer with the other structure or tenants in common. Let's say Ricky manages to convince founder Frank to open a joint account with him to trade tech stocks. Frank isn't stupid. He is putting up the vast majority of the capital. So they legally structure the account with a fractional split. Frank owns 60% of the assets and Ricky owns 40%. This fractional ownership is the hallmark of a tenants in common account.
Right, the split doesn't have to be 50-50.
Let's run an interactive scenario. Imagine Ricky goes on a hiking trip and tragically, but perhaps inevitably, gets eaten by a bear.
Oh no, not the bear.
In their TIC account, does founder Frank automatically inherit Ricky's 40% share to become the sole owner of the account? Take a beat. No. Frank is entirely out of luck.
In a tenants in common structure, there is no right of survivorship. When Ricky passes away, his 40% share goes directly to his estate. It must go through the entire probate process. It will eventually be distributed to Ricky's legal heirs according to his will.
So Frank is stuck.
Yeah, Frank retains his 60% ownership, but he now finds himself essentially co-owning a brokerage account with Ricky's estate and eventually Ricky's heirs.
That sounds like a nightmare for Frank.
It can be, but this structure is heavily utilized by business partners or people entering second marriages. They want to pool their money for investment purposes while they are alive, but they want to guarantee that if they die, their specific portion of the wealth goes to their own children or family rather than accidentally enriching their business partner.
Speaking of business, founder Frank eventually realizes that having his name on anything associated with Ricky is a massive liability. He dissolves the joint account. He decides he just wants to open a brokerage account for one of his LLCs. He wants to open a corporate account.
That makes sense.
When Frank fills out the application, he cannot use his own personal Social Security number. A corporation is recognized by the government as its own distinct legal entity, an artificial person. Therefore, it requires its own tax ID, an EIN, and an employer identification number.
Right. But from the broker-dealer's perspective, they face a unique problem. The corporation can't pick up the phone and place a trade. A human has to do it. But how does the broker know which human is legally allowed to risk the company's money?
This is a major exam trap.
Huge. The broker-dealer will not just take Frank's word for it, even if Frank's business card says CEO and founder. To open a corporate margin or cash account, a document called a corporate resolution is absolutely mandatory.
Corporate resolution.
Yes. This is a formal, legally binding document passed by the corporation's board of directors. The resolution specifically identifies the exact individuals, by name and title, who possess the legal authority to execute trades and sign documents on behalf of the entity.
And if they don't have it?
If that corporate resolution is not on file, Frank cannot do anything. The broker's hands are tied. They need written proof of authorization to protect themselves from being sued by the corporation's shareholders for allowing an unauthorized employee to gamble with company funds.
And because Frank's company is depositing $5 million into this account, the firm categorizes them as an institutional customer. The exam wants you to grasp how institutional suitability differs from retail suitability. When a broker recommends a complex derivative strategy to Prudent Penny, a retail investor, the broker has to meticulously prove that Penny understands the risk and can bear the loss. The burden of proof is very high.
But with institutional customers, the standard shifts. Notice we say the standard is different. We don't say it's lower. Institutional customers like Frank's Corporation or a hedge fund or a bank are legally presumed to be sophisticated. They have their own internal teams of financial analysts, risk managers, and corporate lawyers.
They know what they're doing.
Supposedly, yes. Because they have these internal resources, regulators allow the broker-dealer to rely much more heavily on the institution's own independent judgment and risk analysis. The broker doesn't have to hold their hand the way they must with a retail client.
Frank is a busy guy. Besides his corporation, he also invests in a few real estate development projects that are structured as partnerships. Opening a brokered account for a partnership requires a foundational document called a partnership agreement. This document acts as the constitution for the business, outlining the profit splits, the purpose of the business, and crucially for the broker, who has trading authority. And here we have to draw a hard legal line between the general partner and the limited partner.
A general partner, or GP, is the active manager of the enterprise. They are making the daily decisions, signing the contracts, and executing the trades. Because they hold the power, the law assigns them unlimited liability. If Frank is the GP of a real estate partnership and the partnership gets sued for $10 million, Frank's personal assets, his private bank accounts, his house, his car, are completely on the line to satisfy that debt. He bears the ultimate risk, which is why he is the only one authorized to trade the account.
Now let's look at the limited partner, the LP. Prudent Penny decides she wants to invest in Frank's real estate deal, but she doesn't want to run it. She becomes a limited partner.
An LP is strictly a passive investor. Penny writes a check, hands it to Frank, and hopes he generates a return. She has absolutely no say in the day-to-day operations or the trading strategy. Her reward for this lack of control is limited liability. The maximum amount she can lose is whatever she invested. If the partnership is sued into oblivion, creditors cannot come after Penny's personal house or her kids' college funds.
But here's the behavioral trap the exam loves to test. What happens if Penny gets frustrated with Frank's slow returns, logs into the brokerage account, and starts placing trades on behalf of the partnership herself?
Oh, she legally crosses the Rubicon. The moment a limited partner takes an active managerial role in the business operations, like executing trades or signing contracts, they forfeit their limited liability protection. In the eyes of the law, by acting like a general partner, she assumes the liabilities of a general partner. She suddenly exposes all of her personal assets to unlimited risk. The boundaries defined in the partnership agreement are not just suggestions, they are structural legal walls, and overstepping them destroys her protection.
Okay, I want everyone to pause. Take a deep breath.
Yeah.
We need to completely change the vibe right now.
Let's do it.
The stress of Ricky's margin calls, the chaos of Frank's corporate liability, the fear of unlimited risk. Let's leave that entirely behind. Prudent Penny has been watching this circus of wealth destruction, and she's decided she wants no part of it. She is pivoting, she is focusing entirely on the future, she wants to use her wealth to protect and elevate her children. We are leaving the adult casino and entering the highly structured world of custodial and educational accounts.
This is a critical testing area because it forces you to understand the strict legal concepts of ownership versus control when minors are involved. Let's start with custodial accounts. A custodial account is opened by an adult for the financial benefit of a minor. The two structures you will be tested on are the UGMA and the UTMA.
UGMA stands for the Uniform Gifts to Minors Act. UTMA stands for the Uniform Transfers to Minors Act. Before we look at how they differ, we need to establish the two golden rules that apply to both of them. If you take notes, write these down. Golden rule number 1, 1 custodian, 1 minor per account.
Right. Penny has 3 children. She cannot open one giant, efficient, omnibus UGMA account and pool all their money together. She must open 3 separate, distinct accounts. Furthermore, she cannot co-manage an account with her husband. There is no such thing as joint custodians. 1 single adult manager, 1 single minor beneficiary.
Golden rule number 2 is about the permanence of the money. Any gift or transfer of assets deposited into a UGMA or UTMA account is completely irrevocably the property of the minor. Irrevocable means exactly what it sounds like. It cannot be taken back.
Once Penny deposits $10,000 into her son's UGMA, it legally belongs to her son forever. If her son turns 16, develops an attitude, crashes her car, and starts acting exactly like Reckless Ricky, Penny might think, I'm taking that college money back to teach him a lesson. She cannot. The law views that as stealing from a minor. The child owns the assets. The adult is merely the fiduciary manager.
So if they are so similar, what is the actual difference between UGMA and UTMA? It comes down to two factors: what kind of assets you can put inside them, and exactly when the kid gets their hands on the money. The UGMA is older and more restrictive. It is strictly for financial assets. We're talking about cash, stocks, bonds, and mutual funds. And the timeline is rigid control of the account automatically transfers to the child the moment they reach the age of majority in their state, which is almost always age 18.
The UTMA was created later to be much more flexible. You can put almost any conceivable asset into a UTMA. Yes, stocks and cash, but also physical real estate, intellectual property like patents or even fine art. And crucially, depending on the state's specific laws, the UTMA allows the custodian to delay the transfer of control beyond age 18, often up to age 21, or even age 25 in a few jurisdictions. It gives the kid a few more years of brain development before handing them a massive portfolio.
Now, because this money belongs to a vulnerable minor, broker-dealers and regulators put severe guardrails on how Penny can trade within these accounts. We spent the first half of this deep dive talking about margin, short selling, and options. None of that is allowed here. Ricky would have a panic attack trying to manage a UGMA.
He really would. You are strictly prohibited from using margin. You cannot borrow money against a kid's assets. You are strictly prohibited from short selling. You are strictly prohibited from trading speculative options. The investments must be fully paid for, and the strategy must be prudent and conservative.
And we have to talk about the tax burden. This is a common point of confusion. Penny's the one doing all the trading, buying, and selling. But who actually pays the taxes on the capital gains and dividends? The minor does. Because the minor is the legal owner, the income is filed under the minor's Social Security number.
However, Congress realized that wealthy parents were exploiting this. They were transferring millions of dollars of income-generating assets into their toddlers' names to take advantage of the toddler's 0% tax bracket. To stop this, they created the kiddie tax rules. Essentially, if a child generates too much unearned investment income, currently anything over a couple $1,000s a year, that excess income is taxed at the parent's highest marginal tax rate. It closes the loophole.
As Penny thinks about this, she gets nervous. She realizes that handing an 18-year-old $150,000 in an irrevocable UGMA account might not result in a college degree. It might result in an 18-year-old buying a Porsche and starting a terrible band. She wants to aggressively save for their higher education, but she wants to maintain leverage. She wants to keep control of the money.
This realization pushes her into educational accounts. We have another direct side-by-side comparison for the exam 529 plans versus Coverdell ESAs. Let's look at the heavy hitter first, 529 plans. These are state-sponsored education savings plans, and they are absolute beasts when it comes to accumulating wealth. The contribution limits are massive. They aren't determined by federal law, but by individual states, and many allow total contributions well over $300,000 per beneficiary.
Wow. And the tax mechanics are beautiful. The money grows tax deferred, and the withdrawals are completely 100% tax-free at the federal level, provided the money is used for qualified education expenses. This includes college tuition, room and board, books, and thanks to recent law changes, even up to $10,000 a year for K-12 private school tuition.
But the most important structural distinction, the singular fact you must remember for the exam, is about who holds the power. In a 529 plan, the contributor maintains total control of the account. This is the exact polar opposite of the irrevocable UGMA account.
So if Penny opens a 529 for her son, and her son decides to skip college to backpack across Europe indefinitely, Penny is not tracked. The child does not own the money. Penny owns the account. She can simply log in and change the beneficiary to her younger daughter, or even to herself if she wants to go to grad school. The money stays locked in its educational purpose, but Penny directs who gets it. Furthermore, there are no age limits dictating when the funds must be used, and there are no income limits restricting high-earning parents from contributing.
Now, compare that massive flexibility to the Coverdell Education Savings Account, the ESA. The Coverdell feels like a relic because it is incredibly restrictive. First, the contribution limit is a tiny, frustrating $2,000 per year per beneficiary. Second, there are strict income limits. If Penny gets a promotion and her household income crosses a certain threshold, she is legally barred from contributing a single dollar to a Coverdell.
Furthermore, Coverdell funds have a built-in expiration date. The money must be entirely used by the time the beneficiary reaches age 30. If it's not, the remaining funds have to be distributed. They lose their tax-free status, the earnings are taxed as ordinary income, and they are slapped with a 10% penalty.
Looking at those restrictions, you might ask, why would anyone on Earth use a Coverdell instead of a 529? It comes down to investment freedom. A 529 plan is state-sponsored. The state only gives you a small, pre-selected menu of mutual funds or target date portfolios to choose from. You can't pick individual stocks.
I see.
Right. A Coverdell is completely self-directed. Penny can open it at a brokerage and buy shares of Apple-specific ETFs or whatever she wants to build the portfolio. Also, unlike the 529's $10,000 cap for K-12, Coverdell funds can be used entirely for K-12 expenses without a cap. But if you remember one thing from this section, let it be the difference in control. 529s equal high limits where the parent keeps the keys. UGMAs equal irrevocable permanent minor ownership.
We are now moving into the final stage of our timeline. Penny's kids have graduated using their 529s. Founder Frank's businesses are mature and highly profitable. And Ricky somehow survived the bear attack. He survived his margin calls, and he is suddenly realizing he has gray hair. He needs to stop day trading and start thinking about survival in his old age. We are entering the long game, the complex world of retirement and trusts.
Retirement accounts are heavily tested because, practically speaking, nearly every client a broker interacts with will have one. Let's start with the vehicles individuals open for themselves, individual retirement accounts, IRAs. The exam expects you to know the fundamental mechanical difference in how a traditional IRA and a Roth IRA handle taxes. It is a mirror image.
Let's trace the path of a dollar in a traditional IRA. A traditional IRA is a tax-deferred vehicle. When Ricky contributes $1 today, it is pre-tax. He gets to deduct that contribution from his current year's income taxes. It gives him an immediate tax break, which he loves.
Right. That dollar goes into the account and grows completely tax-free for decades. He doesn't pay capital gains taxes on his trades inside the IRA, but the IRS always gets their cut. The catch comes at the very end. When Ricky retires and finally pulls that money out to live on, every single dollar, both the original contributions and decades of growth, is taxed at his ordinary income tax rate in the year of withdrawal.
The Roth IRA flips that exact timeline on its head. A Roth uses strictly after-tax contributions. Ricky pays his income tax on a salary and then puts what's left into the Roth. He gets absolutely zero tax deduction today. It hurts a little more up front.
But just like the traditional, the money grows tax-free. And here's the staggering magic of the Roth. When he retires and pulls the money out, those withdrawals are 100% tax-free.
Right.
He never pays taxes on the decades of compound growth.
However, the IRS does not give away tax-free growth without attaching severe strings. To qualify for those tax-free earnings from a Roth, Ricky must meet two strict simultaneous conditions. First, the age rule. He must be at least 59.5 years old. Second, the seasoning rule. The specific Roth account must have been open and funded for at least 5 full years. Both of those boxes must be checked. If he's 60 years old but just opened the account 3 years ago, his earnings are not yet tax-free.
Now, what happens if Ricky leaves a corporate job and wants to take his old 401k money and move it into his own personal IRA? This process is called a rollover, and it is a massive, multi-part exam trap. You must understand the difference between an indirect rollover and a direct transfer.
Let's look at an indirect rollover. Ricky calls his old company's 401k provider and says, "Send me my money." They physically liquidate his account and mail a check directly to Ricky's house. Ricky is now holding a piece of paper worth $200,000 of untaxed retirement money. The IRS hates this. They are terrified Ricky is going to cash it and go to Vegas.
Exactly. Because he took physical possession of the funds, the IRS starts a countdown clock. They give him exactly 60 days to deposit those funds into a new qualified IRA. If he gets distracted or loses the check and deposits it on day 61, the rollover fails. The IRS treats the entire amount as an early taxable distribution. He owes ordinary income tax on the whole amount, plus a massive 10% early withdrawal penalty. Furthermore, you are only legally allowed to do one indirect rollover per 12-month period.
Which is exactly why you should never, ever do an indirect rollover. You should always utilize a direct transfer, formerly known as a trustee-to-trustee transfer. In a direct transfer, the money moves electronically, directly from the old firm to the new firm. The check is made payable to the new custodian, not to Ricky.
Because Ricky never has access to the funds, the IRS isn't worried. There is no 60-day ticking clock. There is no mandatory 20% tax withholding. And you can execute as many direct transfers as you want an unlimited number of times a year. It is safer, cleaner, and the preferred method of the industry.
Speaking of 401ks, let's zoom in on employer-sponsored plans. Founder Frank has an entire HR department dedicated to managing these for his various enterprises. For his standard for-profit manufacturing business, he sets up a classic 401k. For the nonprofit educational charity he runs on the side, he sets up a 403b. Functionally, they operate almost exactly the same way: tax-deferred contributions, employer matches, but the 403b is strictly fenced off for public schools, nonprofits, and religious organizations.
And then there is the anomaly, the 457 plan. This is a deferred compensation plan specifically designed for state and local government employees. We are talking about police officers, firefighters, and municipal workers. This is a massive exam trap. If you see a 457 plan, your brain needs to immediately flag one highly unique feature. The 457 plan has NO 10% early withdrawal penalty.
Wait, none at all?
None. Let me explain why. A police officer or a firefighter often works a physically brutal job that forces them into early retirement, say at age 45 or 50. If they were stuck in a standard 401k, they would be punished with a 10% penalty for withdrawing their money before age 59 and a half to survive. The 457 plan eliminates that penalty. If an officer separates from service at age 45, they can start pulling from their 457 plan immediately to pay their mortgage without paying that 10% penalty. They still pay regular income tax, but the penalty is waived.
Wow, that is a huge structural exception based on the reality of the profession. Jot that down: 457 equals no 10% early penalty. Now let's zoom out on the entire concept of employer plans. We need to clearly define who is actually bearing the financial risk of the market. We have to compare a defined benefit plan versus a defined contribution plan.
A defined benefit plan is your classic mid-century traditional pension. In this model, the employer makes a legally binding promise. They define the benefit. Frank's company promises to pay Ricky $3,000 a month every month for the rest of his life, based on his salary and 20 years of service. Frank's company pools all the employee money into one giant trust and hires managers to invest it.
Let me ask you this. If the stock market crashes by 40% the week before Ricky retires, who takes the financial hit? Who loses out?
The employer takes the risk entirely. The employer made a mathematical promise of $3,000 a month. That promise doesn't evaporate just because the stock market had a bad year. If the pension trust's investments perform poorly and are underfunded, Frank's company has to reach into its own corporate treasury, its own operational profits, to make up the shortfall and fund those checks. The employee is completely shielded from market volatility.
Now, contrast that protective bubble with a defined contribution plan, which is what a standard 401k is. In a defined contribution plan, the only thing that is defined is what goes in the contributions. Ricky contributes 5% of his paycheck and Frank matches 3%. That's it. There is zero promise of what will come out on the other side. The money goes into an individual account with Ricky's name on it, and Ricky is responsible for choosing his own mutual funds from a menu.
Right. And if the market crashes by 40% the day before Ricky retires, who takes the risk? The employee takes the risk entirely. Ricky's account balance plummets from $500,000 down to $300,000. Frank's company owes him nothing extra. Ricky just has to cancel his vacation, delay retirement for 5 years, or figure out how to live on less.
The exam loves testing this fundamental shift in modern finance. Defined benefit equals employer bears the investment risk. Defined contribution equals employee bears the investment risk.
Now, regardless of whether Ricky has a traditional IRA or a 401k, the IRS has a fundamental philosophy. They are incredibly patient, but they are not stupid. They will let you defer taxes on your retirement savings for 30 or 40 years. But eventually, they demand their cut to fund the government. They will not let you defer taxes forever and just pass the untaxed money to your kids. This brings us to the rigid mechanism of RMDs, required minimum distributions.
By April 1st of the year, following the year you turn age 73, the waiting game is over. You're legally forced by the federal government to start pulling a specific mathematically calculated percentage of money out of your traditional IRAs and 401ks every single year, and you must pay ordinary income taxes on those withdrawals. Age 73 is the magic number. It used to be 70 and a half, then 72, but currently it is strictly 73.
But what about our favorite tax-free vehicle, the Roth IRA? Exam trap. The test will try to trick you into applying RMD rules across the board. Roth IRAs have absolutely NO required minimum distributions during the original owner's lifetime. Think about the logic. Why does the IRS force distributions? To get tax revenue. But the money in a Roth IRA has already been taxed before it went in. The IRS already got their cut of Ricky's paycheck decades ago. Therefore, they don't care if Ricky never takes a dime out of his Roth and just leaves it to compound tax-free until the day he dies.
But let's look at the dark side of RMDs for traditional accounts. What happens if Prudent Penny, who has millions in her traditional IRA, turns 73? She gets distracted by her grandkids, she misplaces her calendar, and she simply forgets to take a required distribution for the year. She doesn't just get a warning letter. She gets hit with a punitive excise tax on the exact amount she was supposed to withdraw but didn't.
Historically, this penalty was an absolutely brutal 50%. If she was supposed to take out $100,000 and forgot, the IRS simply confiscated $50,000. It was devastating. However, recent legislative changes, specifically Secure Act 2.0, reduced this penalty to make it slightly less draconian. The exam is going to test you on this new updated number. The penalty for failing to take an RMD is now exactly 25% of the shortfall.
25% of the money she failed to take out just vanishes, paid directly to the IRS. It is still a profoundly painful mistake, which is why brokerages have automated systems to try and prevent it. Finally, let's talk about the absolute end of the timeline. What happens when our characters inevitably pass away? Penny and Frank have accumulated massive wealth. They know that probate court is a public, expensive nightmare. They also know that estate taxes can take a massive bite out of wealth being transferred to the next generation.
They want to control their assets, dictate exactly how their children receive the money, and protect it from taxes all from the grave. To do that, they utilized trust accounts. A trust is a three-party legal arrangement. You have the grantor who puts the money in, you have the trustee who is the fiduciary manager of the money, and you have the beneficiary who eventually gets the money.
The SIE exam focuses almost exclusively on your ability to distinguish between the two fundamental structures, revocable and irrevocable trusts. Let's look at a revocable trust first. The key is flexibility. Revocable means the grantor lets a Penny can change her mind at any moment. She sets up the trust, puts her house and her brokerage accounts inside it, but she retains the ultimate power. She can change the beneficiaries if her kids make her mad. She can completely dissolve the trust and take her assets back.
Because she maintains total uninhibited control over the assets, the IRS looks at that and says, that's a nice legal wrapper, Penny, but fundamentally, those assets still belong to you. You haven't truly given them away. Therefore, when Penny dies, all the assets sitting inside that revocable trust are included in the total calculation of her gross estate. If her estate is large enough, those assets will be subject to heavy federal estate taxes. The primary benefit of a revocable trust is not tax savings. It is simply avoiding the public mess and delay of probate court. The assets transfer privately and smoothly to her heirs.
But if you want to avoid those massive estate taxes, you have to use the heavy artillery in an irrevocable trust. Think of an irrevocable trust like launching a spaceship past the event horizon of a black hole. Once it crosses that line, the laws of physics dictate that it can never come back. When founder Frank creates an irrevocable trust and transfers $10 million into it, he gives up all rights, all ownership, and all control forever. He cannot change the terms. He cannot take the money back if his business goes bankrupt. He has legally permanently severed himself from that wealth.
Because he has completely surrendered ownership, the IRS agrees that the money is no longer his. Therefore, when Frank passes away, the $10 million inside that irrevocable trust is completely removed from his estate. It is not subject to his estate taxes. This is the primary mechanism the ultra-wealthy use to shelter generational wealth from taxation. They trade control for tax immunity.
Now, from the perspective of the broker-dealer, a trust account requires extreme diligence. If Frank's lawyer, acting as the trustee, calls the brokerage to open an account for this trust, the broker-dealer must obtain, read, and thoroughly review a certified copy of the actual trust document. Why? Because the trust document is the absolute law governing that money. It outlines exactly what the trustee is allowed to do.
If the trust document specifically states the trustee shall only invest in conservative investment-grade bonds, and the trustee calls the broker trying to buy level 4 naked call options on a meme stock, the broker has a legal and fiduciary obligation to block that trade. The broker must uphold the boundaries of the trust document, protecting the unseen beneficiaries from a rogue trustee.
And with that, we have traversed the entire landscape of customer accounts. We started with Ricky's Deli Sandwich representing the strict pay-before-you-eat rules of cash accounts. We navigated the dangerous leverage of margin, the conflict of interest in discretionary trading, a gauntlet of options approval, and we ended behind the permanent, impenetrable legal walls of an irrevocable trust. let's do our rapid-fire recap. Listeners, don't write this down. Just let these concepts wash over you and solidify.
Free riding. That is specifically selling a security before paying for the original purchase. The penalty is a 90-day freeze, which does not close your account. It simply means you must pay for everything completely upfront before trading. Margin requirements. The initial requirement is 50%, strictly controlled by the Federal Reserve under Reg T. The ongoing maintenance requirement is 25%, controlled by FINRA. And remember, out of the 3 margin agreements, the loan consent form is entirely optional.
Discretionary trading. The 3 A's: asset, action, amount. If the broker chooses any of those 3, they need a written power of attorney. If the client chooses the 3 A's and only leaves the time and price up to the broker, that does not count as discretion. Joint accounts. JTWROS has survivorship. It bypasses probate and goes straight to the surviving owner. Tenants in common has fractional ownership. It goes through probate to the deceased's estate.
Education. 529 plans allow massive contributions, and the parent maintains total control over the beneficiary. UTMA and UGMA accounts belong to the minor irrevocably. You cannot take the money back. Retirement. 457 plans are unique because they have absolutely no 10% early withdrawal penalty. And if you forget to take your required minimum distribution at age 73 from a traditional account, you get slapped with a devastating 25% penalty tax.
It is a massive amount of technical data. But if you can anchor yourself to the why behind those points, why the Fed fears leverage, why the IRS enforces RMDs, the exam questions won't feel like a memorization test. They will feel like basic logical common sense. Here's a final, slightly provocative thought for you to mull over as you close your books for the night. Every single account type we discussed today, every complex regulation, every required signature, every agonizing disclosure document, none of it exists in a vacuum. It was all invented as a direct response to human nature. So we created Reg T and margin maintenance rules because people are inherently greedy and will over-leverage themselves into bankruptcy if you let them. We created strict discretionary rules and Reg BI because, frankly, some people are untrustworthy and will churn a client's life savings just to farm commission fees for a quick buck. We created the rigid laws of trust because, deep down, we desperately want to control our wealth and protect our legacy even from the grave, which you absolutely cannot do unless you have the exact right paperwork. Keep studying, look for the human behavior behind the rules, trust the process, and we'll see you on the next deep dive.